You are watching Macro TV. We are still busy with the basic model of the macroeconomy in Study Unit 2, Chapter 3 in Fourier and Berger. This is video number 3 of 10 covering Chapter 3. In the previous video, we introduced the demand for money. Now we are turning to the money supply. The money supply is defined as the nominal stock of money that is present in the economy at a particular moment. Now, the amount of the money that is available is a function of money created by the Reserve Bank, but also by financial institutions. And we'll talk about the credit multiplier in a moment. Now, there are a number of different definitions for the money supply. You'll maybe recall them from Economics 1. M1A is all the notes and the bank coins in circulation, and also the check and transmission deposits held by the private sector at monetary institutions. Now, this is as close as you get to saying cash. M1 is M1A plus other demand deposits. Now, you may not be familiar with the term demand deposits. It basically means a deposit with a financial institution that is available on demand. So you can immediately get your money and use it to transact. When you get to the broader definitions, M2 and M3, you'll see that the money is not immediately available anymore. So M2 would be M1 plus short-term deposits and medium-term deposits. Now, these are typically fixed in some way. Maybe you need to give 30 days notice before you can get your money and use it for transactions. And by the time you get to M3, that's the broadest possible definition. Then it also includes long-term deposits, and those you can't quickly turn into cash. So you'll see our definition goes from very liquid and available for transactions through to not that liquid, and it takes a while before you actually have the money available for transactions. Now, the determinants of the money supply, the money creation process is basically driven by lending that the commercial banks do, and it's the working of the credit multiplier that we'll talk about in a moment. But it can also be influenced by a Reserve Bank monetary policy, which we'll mention at the end of this video. So the money creation process you're also familiar with from Economics 1. An individual or a firm can receive money, well, we don't know from where, we just say it's an injection into the system, and that money gets deposited into a commercial bank. Now, typically, banks don't want to hold on to money. They want to loan it out to someone else and earn interest on that in order to pay the original depositor some interest. So a portion of the initial round of money that comes in is held back by the bank in form of the cash reserve requirement, and another part of it is loaned out. The borrower then goes and buys goods and services, and the supplier of those goods and services, or the seller, receives some money and puts it back in the bank. Some portion of that deposit gets held back as a cash reserve requirement, and the rest again is loaned out to someone, and this cycle continues. Now, this process of lending and re-lending can take place a number of times, and eventually it causes the stock of money to be much greater than that initial amount of money that went into this sort of chain of events that started right with the first deposit. Now, this process is called the credit multiplier process, and it's a function of the cash reserve requirement that the banks have. So they basically need to retain some percentage of the deposits that they receive, and the rest they can loan to people or institutions. So typically, the reserve requirement is set at 0.25% of total liabilities, which would give you a credit multiplier of around 40. So it's possible that the banks can hold excess reserves. They can hold reserves greater than 2.5% of the total liabilities. And of course, this will lower the amount of money that they can then re-lend and in that way fuel the credit multiplier process, and that would restrain money creation. So why would banks hold excess reserves? They might do so in periods of uncertainty. It gives them more security. It's a buffer against possible unexpected large withdrawals of cash. But having excess reserves has a huge opportunity cost. You promise the depositors you'd pay them some interest, and just having the money in the bank is not earning interest. So banks is really their main business is to loan out that money to other people. So a high reserve requirement discourages money creation. And if interest rates are high, they would really like to loan out all that money to other people, which means that there's a positive relationship between the interest rate and money creation, or the supply of money. Now, the Reserve Bank can influence the money creation process. To recap, if you have an initial injection of money that increases the money supply, and some of it gets withdrawn in the banking system and held as a cash reserve. The Reserve Bank can influence this. They set the cash reserve requirement. So if they increase the requirement, that's going to decrease the money supply. And the other way around, if they make the reserve requirement smaller, that is going to increase the money supply. So that's a possible way that the Reserve Bank can influence the money supply, but there are two other ways as well. They can use the repo rate, and they can also use open market transactions. Now, typically, the repo rate is the rate at which commercial banks borrow money from the Reserve Bank. Now, we'll get into the details of why they would do that at a later stage, but from time to time, commercial banks need cash, and they would then sell financial instruments to the Reserve Bank at the repo rate. It's also called the repurchase rate. So the rate at which they would then later repurchase those financial instruments from the Reserve Bank. Now the bank sets this repo rate. So if in that way they can encourage or discourage money creation. If the repo rate increases, that discourages loans from the Reserve Bank and it limits the money creation process. The Reserve Bank can also intervene directly into the open market, where they can buy and sell government bonds in the secondary market. If they sell bonds, that means they are getting money in, cash is coming into the bank in return for the bonds, which is just financial value paper that will then be held by banks or insurers. If they buy bonds, that means they get their value paper back, but they also then, at the same time, put cash back into the flow. So in both of these ways, the Reserve Bank uses their available instruments to influence money creation. So we looked at the determinants of the money supply and the role of the bank. The next video will look at the derivation of the money supply function.